Welcome and thank you for joining me for Tax Break. This is a podcast about South African tax for South African tax professionals and practitioners. My name is Pieter van der Zwan, and in each episode I share my thoughts with you on a topic or a recent development in the field of South African tax. And I try to keep it to the time that you would have available if you want to take a quick coffee break from work. Our topic for today is dividend stripping. And I would like to focus on the concept of dividend stripping for you to be able to identify that you may potentially have an issue, rather than the detail of what the legislation says about these rules and when the triggers would happen from a legislation perspective. Right, so to talk about the concept, I think it's necessary to talk about the transaction without dividend stripping to see what let's call it the normal transaction would look like. So let's assume we've got the following scenario. We've got company or shareholder A who holds the shares of company X. And let's assume that A started company X with minimal capital, so there's very little base cost in the shares for A. And we further assume that these shares have a value of approximately 10 million rand. So A now wants to realize his 10 million rand value that's built up. And there's a few ways in which he can realize this value. Firstly, company X can sell the business to a purchaser. So in other words, transfer the assets and the liabilities, the going concern, to a purchaser. This transaction would typically have capital gains tax consequences on some of the assets. There could be recoupments on assets that were previously depreciated for tax purposes. And once you've got the after-tax proceeds sitting in company X, when Mr. A extracts that value, there would be dividends tax on the extraction. An alternative to this would be for A to sell the shares of company X. Now, as we've mentioned, because there's not much base cost in these shares, it's likely that the capital gain will be fairly significant, so fairly close to the 10 million rand value that's in the shares. The benefit here would be that because the proceeds accrue to Mr. A, not to the company, there's no further dividends tax. And I think a last alternative would be for the buyer to somehow fund company X and for company X to buy the shares that Mr. A holds back from him. Now, that buyback of the shares by the company from Mr. A would be a dividend for tax purposes and would again attract dividends tax. So all these alternatives would have a capital gains tax and or dividends tax implications. Now, this picture can change quite significantly if the shareholder is not Mr. A but a South African company. The reason for this is that there's a company-to-company exemption from dividends tax. If it's so, in other words, a resident company pays a dividend to another resident company. If I can perhaps just stand still on it for a little bit to explain the purpose of this exemption. So under the old STC system, STC was payable on the net dividends paid by a company. So in other words, the dividends declared minus the dividends received, and that was the STC was levied on the difference between the two. Now, the dividends tax system as we've got it now looks at the gross dividend declared. So there's no acknowledgement or recognition of the dividends received. And if dividends that flowed from one resident company to another were subject to dividends tax, you would have the following scenarios. So let's say we've got an individual. He holds all the shares of company A holds all the shares of company B holds all the shares of company C. And under in the structure, there's 100 rands of profits that accrue to company C. Now, if that 100 rand of profit passes up through the layers to the individual, and it weren't for this company-to-company exemption, you would find that there's 100 rand flowing from company C to company B. There's a 20 rand dividends tax on that, so there's 80 rands left. After 80, you would have, if it wasn't for this exemption, there would be another 20%, so another 16 would flow out when the dividends flow from company B to company A. And on whatever remains, another 20% would leave as dividends tax if the dividends flowed from company A to the individual. And through this, the multiple layers of companies, you could end up in a scenario where you've got very little actual distributable profits left after dividends tax. And that's because the dividends tax system doesn't take into account dividends received. It's levied on the gross dividend paid. So the way that the system works then to prevent the staggering of layers of different layers of dividends tax is to give the company to company exemption. So how it works then, the dividends that flow from company C to company B are exempt from dividends tax because it's between two resident companies. From B to A is exempt, and only when the dividends flow from A to the individual, then they would be subject to dividends tax. Now, let's go back to our scenario. If we then say that Mr. A wants to dispose of these shares in company X, and we can place a company in the place of Mr. A, the opportunity opens up for the buyer to fund company X to then use that money to pay a dividend to the new company that is owned by Mr. A. And in doing this, so by funding the company X and paying a dividend through a share buyback to the new company shareholder, this proceeds becomes really tax-free. Now, if you look at or you think about how you can get this company shareholder in, it's fairly simple using Section 42. And if you think about it for that purpose, you can really dispose of many assets in this way by firstly using Section 42 to put the asset into a company, and then another Section 42 transaction to get a company to be the shareholder of that company. Now, this practice that I've described where taxable proceeds are converted into exempt dividends, that's really what dividend stripping is. So what distinguishes dividend stripping from normal dividends? And I think the answer to that lies in the fact that the dividend stripping transaction is associated with the shareholder disinvesting from the company in some way and receiving the value of the shares in the form of a dividend. Now, around 2016, the National Treasury introduced anti-dividend stripping rules to curb this practice. So the idea for today was not to go into the detail of the rules, but I do think it's necessary to at least say that essentially what these rules then do. If they apply, they deem the dividends that are susceptible to dividend stripping to be proceeds or gains that become taxable. So in other words, they are not just exempt dividends, they become taxable proceeds. And this reflects the real substance of the potential underlying transaction that's happened. Now, there is quite a bit to these rules, whether they apply or not, and what the effect would be if they apply. And that wasn't quite the purpose of today's session to go into that detail. If you would like me to do another session on that, then you are welcome to let me know. My email address is in the show notes. But I think that's about where we'll end for today. So in closing, the broad topic of what dividend stripping is, once you understand that, that's the first step to being able to identify whether you need to do a deeper analysis or not. So that's it for today's episode. Thank you for listening. And if you enjoyed the episode, please subscribe on your podcast platform and tell all your colleagues and friends about it. If you've got any questions that you would like me to address in a future episode, you're more than welcome to send me an email. As I said, my email address is in the show notes. And as always, nothing in this podcast was meant to be tax advice or even to be a substitute for fact-specific tax advice. Until next time, goodbye.